A strong finish to the third quarter brought the TSX into positive territory for 2017 so far. Low oil prices are at the heart of the lackluster performance, but our next guest expects the final quarter to come in strong for Canadian equities. For more, we're now joined from the TSX by Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management. Diana, good to be with you today. Thanks,
Catherine, for having
me. You said last time that you were on with us that you thought that the TSX would play a bit of catch up. We're up 2.6%. Still far underperforming the majority of indices around the world. What's next?
I think that it continues its path to narrow the underperformance. Canada always benefits when oil acts, when oil behaves okay. Doesn't have to rally much but definitely not sell off much. But if it's on a close and narrow path upward, that's okay. It seems to have stabilized somewhat. And although oil earnings are less of a percentage of the total TSX earnings than they have been in the past, it does translate into other sentiment indicators for Canada and into the financials earnings. Financials earnings are now 50% of the total S&P earnings, which has increased over the 10 years, and energy earnings have gone down over the 10 years. But it still matters a lot, both in terms of how much it matters to the actual underlying and also in terms of the sentiment that Canada is exhibiting towards the international investment community. So it matters.
And where does that stand right now in terms of the interest in Canadian equities, do you think?
I don't have exact numbers. Those are just gut feels, but we have been talking about this last time. We have been seeing the international community taking off shorts and investing in the Canadian banks, particularly with the last quarterly report where the Canadian banks came in surprisingly strong. There was a lot of negative sentiment. And so foreign money has been flowing into Canada. And with oil stabilizing and actually rallying about 51, despite the fact that it's down 2.5% today, we're still above 50. To your point, it's a bit psychological. But even if it was to break somewhat, it is doing a little bit of good work, and so that tends to bring in foreign money into the Canadian market, and that tends to affect us. A lot of our volume in the TSX is foreign money.
That's hard to believe that it has such a big impact, Diana.
I know. Canada, UK, Australia, those are all considered by international asset managers as the commodity trade. And so when that's working, it tends to be that. We're coming up this year and last year as well. We've IPO'd a lot of good consumer companies, consumer discretionaries and so forth. But, it's still the commodity, the energy, the oil and gas, and the financials. It's always a one-way trade up or down.
Diana, I want to ask you, not to put you on the spot, but DHX Media, I don't know if you own it, but the stock's halted. It was halted at 218. I don't know if you are involved in that name at all.
Sorry, I didn't see that.
Okay.
I was out of the office.
That's okay. Just wanted to have a quick check.
It had some issues lately.
Yes. All right. When we take a look at the rest of the market, though, what do you want to avoid right now on the TSX?
What do we want to avoid? What do we want to avoid? So oil is okay. We have been raising our weight. In terms of the financials, they've been okay as well. The Canadian dollar, I expect, will stop going up. So perhaps, those with costs in US dollars and revenues in Canada, those might find it a little bit more squeezy. But I don't think we're going to see that till a quarter or two ahead.
Okay. Let's shift focus here. Well, actually, let me ask you then, where are you overweight in Canada right now?
Well, we've just started as you know, we were overweight the U.S.
Right.
For a very long time. And where we have been adding is we've been adding to this energy trade. Look, we don't know whether it continues or it goes up. But for now, the indicators that we're looking at, we're very disciplined looking at things from the top down, sector-wise, and then bottom up. So as these sectors are showing up for us positively, we add to the sector. So energy has been a net add for us. Financials, we have been there already. So that's where we would be mostly in Canada. Yeah.
Diana, let's shift our focus to what's going on in the United States. Those markets hitting record highs once again. I know you've been a big buyer and owner of U.S. equities, but I think you've been shifting, as you just said, maybe trimming some of those U.S. positions. But you know, is now the time really to trim U.S. positions? I mean, people are buying back into that reflation trade, the Trump trade, tax reform. Those markets feel a little bit on fire.
They really do. And, you know, everything that you mention as reasons, that's all correct. But even if we were to strip it out, at the very basics, markets get driven by earnings. And the tax trade, if it goes through, will boost that. It'll be a bonus. It'll be a bonus about 8 to 10%. But even without it, we have earnings growth on path. So is it time to sell U.S. stocks and buy Canada? Look, you can have a portfolio that benefits from only a certain amount of diversification. You don't have to sell everything. You can trim, and you know, if you were fully invested, you can trim, take profits. You have 40 to 60 names. You can trim into those names that you think are coming up next. As you know, we don't sell because we reached a target. We let our winners run. But there's always something that's underperforming relative to what's working. So it's not always an absolute trade. Sometimes it's a relative trade.
Well, let me ask you.
In the U.S., we think it keeps on going.
Okay, so the U.S. market keeps on going, but some of the relative underperformers, just even over the past couple of weeks, it's pretty shocking to see the price action in company stocks like Apple, Facebook, Google. I mean, we can bring them all up today. What do you think is going on there? Is it the potential regulatory issues, or is it that area being used as a source of funds to move into more value-oriented trades, valuations? What is it?
It could be that. It could be what you're saying, Catherine. I'm thinking it could be also a bit of a tax trade. The tax benefit. If the tax plan goes through, will benefit some companies more than others. The tax plan has a 10% tax on foreign profits, no matter what. So some people are scratching their heads as to how this is going to work. It'll cut out a little bit the tax arbitrage or the global tax arbitrage that could be going on currently if that tax, whatever percent, some are saying 15, some are saying 10, but if that tax on foreign profits actually materialize. And I just have to wonder whether these FANG stocks, whether they have a lot of, they benefit from a tax repatriation holiday. So maybe by the same token, they benefit less from the fact that there is a 10% or there will be a 10% tax on foreign profits relative to others. Let's make clear that cheaper taxes benefit everybody, and we're here talking just about relative benefits.
Right. But they have shown quite a bit of weakness. When you take a look at the FANG stocks, are there any of those names that you would want to trim right now? We were talking about Apple last time we were on, and Apple was at 159. It's now at 153. You scratch your head why they launch 8 a month and a half before 10, so it's kind of expected. I think they're still okay. There's still growth there. I think there's a bit of rotation. What's also moving the needle is that the financials stand to benefit doubly from the tax implications, because as we see these tax reforms go through, where that's hoped to be funded from is growth, GDP growth. If that is indeed going to materialize, then what happens is the Fed has growth, that is, economic growth, if it materializes. The Fed has more leeway to normalize the balance sheet or allow yields to go higher. And if that's the case, then higher yield steepens the curve, further benefits the financials. So we're definitely seeing that rotation, both from a taxation perspective and both from a fact that they've just gone so much. And Okay, Diana, great to see you. Thanks so
Catherine.
much. Thank you.
Thanks for having me.
That's Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management.